Welcome back to another stock analysis, where I look at some key metrics to calculate the fair value and my buy price for the stock. Today I'm going to analyze Colgate-Palmolive, which is one of the biggest companies in the defensive consumer sector. Last, they generated a revenue of $17.4 billion and have a market capitalization of $63 billion. The revenue of Colgate-Palmolive can be divided into four main segments, which are oral care with 44%, personal care with 20%, pet nutrition with 19%, and home care with 17%. Colgate-Palmolive own a lot of different brands, which people use in their everyday life. And you might know some of them, such as Colgate, Xanax, Ajax, or Hills. They are not only diversified in their product portfolio, but also in different countries. They actually sell their products in over 200 different countries. And 26% of the revenue is made in North America, 26% as well in Latin America, 20% in Asia Pacific, 20% in Europe, and 7% in Africa or Eurasia. If you want to know the exact numbers of how the revenue is divided, you can check out the annual report of Colgate-Palmolive, which I've linked down below. Enough about the introduction. Let's find out if Colgate-Palmolive is a good stock to buy at its current value. To find out if the price of the stock is interesting, I usually use the dividend yield. To start with, I plot the dividend yield for the last 3 years in a historical chart. To create some sort of signal line, I plot the 5 years moving average of the dividend yield too. The whole idea behind this chart is that the stock seems overvalued when the yield is under the moving average, and vice versa, the stock seems undervalued when the yield is over the moving average. This weighting approach of course only makes sense when the company can demonstrate a long and sustainable dividend history. The average of the last 5 years for Colgate is 2.38%, and I would like to define this as the historical dividend yield. Since my weighting model is based on the historical yield, it should be as stable as possible. Mathematically, I can calculate how stable this matrix is by calculating the relative standard deviation, which for Colgate is 3.5%. To the historical yield, add a personal defined margin of safety of 25%. This margin of safety will be adjusted upwards or downwards depending on the matrix of the company. My first criteria is the stability of the dividend measured with the relative standard deviation. With this value, I can measure how volatile the dividend yield is. A high relative standard deviation would higher my risk to invest at a bad timing. As said earlier, the relative standard deviation for Colgate is 3.5%. This value is in the green section of my rating scale, and therefore I'll subtract 5% from the margin of safety. The next important matrix for me is the dividend growth. In 2007, 70 cents were paid, and currently the yearly dividend is $1.86. The dividend growth of the last 5 years is thereby calculated to be 3.2%. The company has a long dividend history and actually earned the title Dividend King, which means they have paid and increased the dividend for at least 50 consecutive years. To be precise, Colgate has paid and increased the dividend for 59 consecutive years. Anyway, a dividend growth of 3.2% is in the yellow section of our rating scale, which therefore the margin of safety doesn't change. But if we want to investigate whether the dividend growth is sustainable for the company or not, the payout ratio should be evaluated. I always look at the payout ratio in respect to the free cash flow, which is the cash flow the company has available after they've paid all necessary expenses. The free cash flow from Colgate has increased from $2.6 billion in 2018 to $2.8 billion in 2021. The cash dividend were respectively $1.4 billion and $1.5 billion. The average payout ratio thereby becomes 52%. This value is in the yellow section of our rating scale, and therefore the margin of safety once again doesn't change. Before we continue the analysis, I would like to remind you that if you like my stock analysis, you can support the channel by liking the video and subscribe to the channel if you haven't already. If you also would like to support me financially, you can check out the links in the video description, where you can open new portfolios or buy some great investor books. With that being said, you can of course also just continue to watch my videos, which is already a huge support. But for now, let's get back to the analysis. Next, I'll take a look at the debt situation. The company has a debt of $6.4 billion and have $0.8 billion in cash. When the cash gets subtracted from the debt, and this value then gets divided by the EBITDA, the debt to equity ratio is found. The EBITDA is currently at $4.4 billion, which leads to a debt to equity ratio of 126%. This matrix tells us that the company could pay off the whole debt in around a year if they wanted to. This matrix is in the yellow section of the rating scale, and therefore the margin of safety doesn't change. For the business to be sustainable, growth is the very important factor. The revenue has increased from $50.5 billion in 2017 to $17.4 billion in 2021. This gives an average growth of 3%. In the same period of time, the EBIT decreased slightly, with an average decreasement of 0.3%. The margin is found by dividing the EBIT with the revenue, which in 2017 gives 25.4%, and in 2021 decreased to 22.3%. Since the revenue increases at a higher rate than the EBIT, it only makes sense that the profitability of the company decreases. In this case, it decreases with 3.2% in average. An EBIT growth of minus 0.3% is in the red section of a rating scale, which gives plus 5%. For an average margin growth of minus 3.2%, I'll add further 10% to the margin of safety. When the aim of an investment is to buy and hold for decades, it makes sense to relate the current dividend yield and the dividend growth. I do this by calculating the potential yield on cost. The company currently has a dividend yield of 2.47%, and as mentioned earlier, the dividend growth for the last 5 years is 3.2%. To really take advantage of the snowball effect that investing offers, I reinvest every payment. But since there are 50% withholding taxes for stocks from the US, I subtract 15% from every dividend payment. Thereby, the potential yield on cost after 5 years would be 3.3%, after 10 years it would be 4.4%, and after 15 years it would be 6%. And of course, it is difficult to predict the future, if not impossible. But this matrix still gives a general idea where the potential yield on cost is going and what I could expect in a few years. A potential yield on cost of 6% is in the red section of a rating scale. Therefore, I'll add 5% to the margin of safety. Since every matrix from analysis has now been collected, it is time to adjust the margin of safety. Minus 5% for the relative standard deviation, plus 5% for the EBIT growth, plus 10% for the margin growth, and plus 5% for the potential yield on cost. Thereby, the new margin of safety becomes 40%. This leads to a desired dividend yield of 3.33%. By a current dividend of $1.86, I should therefore don't pay more than $56 for the stock. By ignoring the margin of safety, the fair price of the stock is determined, which for Colgate is $78. These values can also be shown graphically in the chart for the historical dividend yield. This is done by adding a new curve which always lies 40% over the historical yield curve. Now you can see in the graph that the yield curve is over the historical yield and under the margin of safety curve. This suggests that the stock is currently undervalued in regard to the historical yield, but overvalued in regard to the margin of safety. This can also be illustrated in stock prices. I consider the stock at its fair value when the price is $78. I would buy the stock at $56, and the stock price is currently at $75. That's it for today's video, and thank you for watching.